And this week we're going over a stock we haven't gone over in a long time, or at least since last year, and we have all sorts of new numbers on it. And it is in the computer software business, as you all know, and it is our good old friend Microsoft. And remember, folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And let's go over what Microsoft does, and this is leading up to something. Microsoft is the largest independent maker of software, develops, sells software products for a wide range of computing environments in consumer and enterprise markets. Hardware products include the Xbox video game console. And folks, as you know out there, Microsoft is trying to buy Activision. And Activision is that game group out there, and they use the iCloud, so you can see the video game console here might be a good addition to Microsoft. But anyway, revenue sources this past year: productivity and business processes 32%, intelligent iCloud and 38%. And folks, this part of the company is growing, and of course this is where Activision comes in once more. Personal computing 30%, and R&D, research and development, 12.4% of 2022 revenues. So there's Microsoft, and they still want to grow through acquisition as well as their present business processes growing. So let's look at Microsoft and compare some statistics to the average stock. Now, the average stock is in blue, and we're looking at the ROE, return on equity. And folks, everything you see here is clean surplus, and clean surplus is totally different than the traditional accounting methods. That's why this method works so well, and traditional accounting doesn't work very well when it comes to comparing stocks. So the average stock has a clean surplus return on equity of 13.5%. Microsoft 5-year average 21%. Net income 13% for the average stock, and net income is what? Remember, it is earnings, but they're clean surplus earnings. You take traditional accounting earnings, you subtract non-recurring items and future liabilities, and voila, you come up with net income. And we can see that Microsoft is way above the average stock. And when it comes to revenue, it's almost double the average stock. And revenue is money coming in before you take anything away, such as expenses and depreciation and other costs associated with the company itself. So just by looking at this chart very quickly, we can see that Microsoft in green is outperforming the average stock out there, and that's what we want to do. We want to fill our portfolios with above average stocks because we want to outperform the S&P 500. Why do we want to outperform the S&P 500 index? Because in over any 10-year period, 96% of professional money managers who run the publicly traded mutual funds cannot outperform the S&P 500 index. And folks, we do. We do by almost 3-to-1 over a 22-year period. All right, now let's look at some individual numbers, and I want to show you down here. Back in 2020, this company was bringing in earnings, clean surplus earnings of $576, and for next year, they expect to almost double that. Notice that every year the earnings go up. And boy, that is very, very nice to see. And especially after coming off of COVID, this company still went up. Just a slight increase in 2023 over 2022, but then back in stride in 2024. So this is nice, but we want to remember this number of $5.76 for 2020, because I'm going to show you a chart, and the 2024 number of $10.50. Notice the clean surplus return on equity around 20%, and it had been lower back down in here, but then all of a sudden it struck a nice chord and got into a nice income stream, especially with the iCloud up there, and we can see that for 2024, 19.7% clean surplus ROE. Now, when we look at the retention rate, that means how much of the money that the company is making is it putting it back into itself in order to grow. So we see 70%. The rest goes where? It goes out in the form of a dividend. So this company is sort of past its real fast growth stage like a NVIDIA or a Meta. So we look at this and say, yeah, it's still definitely a growth stock, but it's not the type of growth stock that we like to see every now and then and put in our portfolio, such as a NVIDIA or a Meta. But look at this nice steady net income. These earnings, they're nice and steady. We like to see that in a portfolio. And of course, net income growth and revenue growth are both above average. Years to pay debt, Buffett's rule of thumb, how many, if a company takes all the money it's making and uses it to pay off the debt, how many years would it take? He says 5 years or less. We say 3 years or less. This company has almost no debt. So this is why it's one of those companies that are doing so well right now, is because everybody talked about interest rates going up, and they really hit the tech stocks because they said the tech stocks do not do well during an interest rate increase environment. Well, folks, most of the tech stocks that are at least in our portfolio have no debt, so we don't have to worry about that. So even though those stocks fell, beautiful buying opportunity. So I just want to bring out one point down here. When we have market cap, and what's market cap? If you take the number of shares outstanding that are out in the public or mutual funds and multiply that by the share price, you get market capitalization. Now, what usually we have down here, market cap in billions. And of course, those are large cap stocks. But notice this number down here, folks. This is one of the few stocks you will see that says trillion on it. So $2.1 trillion in market cap. Congratulations, Microsoft. And congratulations to all of you who have had Microsoft in your portfolios, which we have for a very, very long time. All right, over the last 12 months, what has the stock done? Black line is the S&P 500. Remember, this is a full year, the last 12 months, and it was doing as well as the S&P. Then it fell below the S&P for a while, and now it has just taken off. So with the market up about 16%, this stock is up about 32%. So we're looking at doubling the S&P over the last 12 months, and most of it has taken place in the last 4 months. Over 5 years, black line, the S&P 500. And folks, this is the kind of stock you want in your portfolio. With the market up about 60% over the past 5 years, this stock is up about 230%, almost 400% better than the market itself. Kind of stock you want to see in your portfolio, folks. And let us go back to the last 5 years. Now, the black line is Microsoft here. And we're going back. So this is 2023, 2022, 2021. This is 2020. So remember, Microsoft was making toward the end of 2020, we knew that the stock was going to make about $5.75 a share, and it held steady around this $210 level. Well, if it's going to make almost double that next year, we can expect this stock to be double the 210 or around $420. So we think that over the end of this year and next year sometime, we'll see this stock up another $100. And look where it is right now. This is one of the few stocks that have reached its previous highs since before COVID or since forever. Very, very hard to reach a new high while the market is still worried about inflation and recession and rising interest rates. So good job, Microsoft. So folks, we had a very, very good week. And if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. Tide is coming in. The sun is coming up. Beautiful, beautiful day out there, folks. Go out and enjoy your weekend. We'll see you back here next time.